Good Monday. This is Jay Brew, co-chairman of Seafried and Brew. Just in, we've gotten the first quarter of 2013 results for community banks across the country. And as we reported in our quarterly ALCO briefing that Dr. Ed and I did this past week, is that as looking at trends in community banking, there's good news and there's also bad news happening. The good news is trend in non-current loans still come down in here, moving from the peak that we saw last year, and that trend, of course, is a good trend to see, moving down now to 0.56% of total loans. So that continues to work itself out. As I've said, when you go through a credit cycle, it's normally a 5-year period for community banks to work out their non-current loan situations. And coming from the deep recession that we've gone through, it's no wonder that it is taking time to work this out overall. But that piece of bad news that I mentioned is the net interest margin. And we started to see the net interest margin move slightly down in the fourth quarter, but now it's taking a more dramatic decline from 3.83% to 3.71%. And this goes back to a couple of things that we look at in terms of interest rates. In our ALCO webcast, Dr. Ed talked about the reasons that longer term and shorter term rates will be confined in here into the type of trading range that we've seen into the foreseeable future. That his belief is that not only based upon our own economy, which he feels is probably going to grow at about a 1.76% rate over the next number of quarters, is that along with that is our interrelationship with European rates and the effect of the European economy on us. So when we look at that in that confine of having these short-term and long-term rates remaining low, and our options in terms of loans and investments really narrowing in here, not only in terms of yields, but in terms of risk, this is not a good sign to see happening in terms of net interest margin. So as my advice has been earlier in the year, what we want to be looking at is net interest income in total dollars. And it's important that you look at the trend line of this. More importantly is that you have the ability to model out over the next year to see the direction at your own bank in terms of that net interest income. Because what we're seeing is a number of banks, their models are predicting lower levels of net interest income in total dollars as we move in through 2013 and into 2014. But more importantly, you need to do something now to correct it. You can't wait for that trend to continue to decline, because then to make up that lost ground becomes more difficult and more risky. So you need to sit there and say, is the trend in our net interest income declining? What do we do to stop it, especially with the feeling that we could have these interest rates remaining in this zone for the next 2, maybe even 3 years. This is Jay Brew, co-chairman of Seafried and Brew. Have a great week.